Hi, this is Mike Maloney. Jeff Clark was going to be with me today, but he got tied up, and so I'm going to cover one of his articles that he just released. This was back on December 1st, but it's a great article, and it goes together with the article that I covered last week of Jeff's, and between those two, it caused me to do something, to take some action. So these are good articles, and they really add up to something when taken together. So in this article, new report reveals sudden crunch in silver supply. It's a very, very important article. And down in the article, there's this chart of the gap between annual supply and demand balloons. And you can see that the amount of supply, it's like hello demand, goodbye supply. Well, we haven't seen the hello demand part yet. That has yet to come. The big demand is out there in the future, especially monetary demand. It's when markets crash and people get worried and they try and rush back to real money to protect their hard-earned wealth. A little bit further down in the article, so this is the supply and demand each year when there's more supply than when the supplies are growing, and this is when the supplies are shrinking. So further down in the article, you've got the London Bullion Market Association in England, their supply of silver on the markets, and you can see this drastic contraction, which is much larger than anything that has happened since 2016 here. I don't have this graph going back any further right now, but this is a pretty dramatic contraction. And it reminds me of what was going on back in 2007 and 2008 before we took a slingshot move. And I think that this is what we are getting set up again for is another slingshot move. So watch my video from last week on how long can silver remain cheap. And that is about the cost of mine production being right at or just below or even higher than the current spot price, so that the all-in sustainable mining costs of an operation, the operation is economically not realistic at these prices. And so mines either have to high grade, they have to shut down temporarily, they have to wait for higher prices, or they have to go out and dilute their shares by raising more capital in private placements. So when you take all of those together, plus some of these other factors, now Nick Laird from Gold Charts R Us sends me these charts every week. This is transparent gold holdings. So this is all of the repositories like the Commodities Exchange and the LBMA, mutual funds and ETFs, any place that does reporting that holds silver and gold. So this one is gold, and in the background here, the gold line is the price of gold, and this is how many millions of ounces that are have been accumulated or that are being dishoarded. And you can see that there's accumulation, distribution, accumulation. So the supplies go up and down and up and down and up and down and up big time during this price rise. This is the pandemic price rise. So you had the pandemic plunge of the price of gold and the stock markets. The stock markets kept on going. Gold turned right around and took off like a rocket during this accumulation phase. And you had all of these ounces accumulated. So this is millions of ounces over here. This is the gold price. And you can see the millions of ounces went up very dramatically from 90 all the way up to 160. That is a very dramatic increase. And since then, you've had this distribution here, these outflows from the identifiable above ground stocks. There's all of these outflows. And I just want to point out that this runs in waves and cycles. They're not perfectly even. I mean, there's big one there. There's very small outflows on some of these cycles. But this is a regular repeating pattern. And so here is silver over the same time period, and you see the same thing of inflows and outflows, and then all of these outflows that we've had over the past year and a half here. Almost 2 years of outflows. Well, that's a 1, 2, 3. That's a 5-year chart. Let's go to a 20-year chart. And here, the outflows are not quite as evident. There were more inflows during the big price rise from under $5 to just below. It was $48.50 or something like that. I do want to point out, you'll see silver has yet to exceed its 1980 high. Gold has already exceeded its 1980 high twice. Everything else in society is multiples of its 1980 price, and silver is still selling at a discount to its peak in 1980. Now, that was a gigantic peak. It was a bubble, but still, for something to be selling at a discount to its 1980 price, and a severe discount. On the Chicago Mercantile Exchange, silver hit $52.50. It hit 48 something according to stock charts in 2011 here, not $50. There's some people that say $50, but still, that's not above its previous high. And then when you go with weekly or monthly data, the high in 1980 comes way down. When you're going intraday data, that's when you get the 52.50 price. But if you look at the amount of outflows that we had here over the past year and a half, they are huge, or the past year, 2022. So then we'll move on to a 50-year chart. So this takes into account 1980, but now this is monthly data. And so when you average the monthly price back in 1980, it comes down below 40, but it was 52.50 on one day. And so what you see here, though, is this pattern of sort of waves and cycles, and then the biggest withdrawals, the biggest selling, the outflows in the history of this chart in this past year. And it looks to me like all of this is coming to an end. So let's take this information of the supply-demand situation that we started this video with, and the crunch of the cost of production being at, or in some cases, some mines are not profitable now. They are losing. The majority of them are below. The silver's price is below their cost of production. And there's just a few that are actually making a positive cash flow right now. So you add the supply-demand crunch that we've got with less supply coming to the market to the fact that the miners cannot make a profit at it. On it at this price point. There's no reason for them to dig it up and bring it to market. Those two things have to resolve themselves. And the only way that they can resolve themselves is through a higher price. And then you take a look at these inflows and outflows, investors being interested in precious metals and then disinterested. And it looks like the disinterested part is about to end. And what you come up with is that very shortly we could have another one of these slingshot moves. And if any anxiety over the economy gets added to this, if people start rushing back to real money, gold and silver, to protect their wealth like they have for the last 5,000 years, if they do that and demand goes even higher with the cost of production above the price that a miner can get for it, and then these waves and cycles and you add all of this together, and you have a potential slingshot explosion that is laying out there for the price in gold and silver. And then you add some of the backdrop of the economy to this. Home sales have never, this is from Alf at Macroeconomic, home sales have never dropped so fast and so hard like in this Fed hiking cycle. So starting from the first month of rate hiking and measuring it on, and then these are all of the last rate hiking cycles, the housing market is effectively frozen, and the illiquidity is popping up in the real estate linked products too, like Blackstone B REIT. This is a real estate investment trust, so a REIT, Blackstone REIT, B REIT. And you can see that in this cycle, it's dropping. And here is one thing that they're not saying. The Fed is raising rates into the most massive bubbles that the Fed has created in history. The stock market, real estate, and bonds. You know, when they were raising rates in the late 90s, when Alan Greenspan was raising rates, that was just a stock market bubble, not real estate, not bonds. In 2007, it was a giant real estate bubble and a stock market bubble that Alan Greenspan and then Ben Bernanke were raising rates into when they caused the global financial crisis of 2008. But now, the real estate bubble is larger than it was back then, back in 2006, 2007. The stock market bubble is much larger than it was back in 2000 with the NASDAQ crash. There wasn't a bubble in bonds back in 2000. Now we have a bond bubble, and they're trying to raise rates at the fastest pace in history into the face of all these bubbles that they created. And on top of that, they added from the pandemic to today, the M2 currency supply is about 40% larger than it was in February of 2020. 40%. So they caused this inflation. That increase in the currency supply caused these massive bubbles in equities and in the stock market, in real estate, everywhere else, in assets. Some of that is coming out into the intergeneral circulation, causing some of the inflation. Some of the inflation is caused by checks that were sent directly to consumers, also increasing the currency supply. And then other parts of the inflation is due to energy and due to supply chain disruptions, the excess demand of coming out of more than a year of lockdowns. In Puerto Rico here, it was very draconian, the lockdowns that were going on. So you add all of these things together, and I really believe that we are set up for a slingshot move. I mean, this is home sales dropping so fast into a Fed rate cycle. I want to remind everybody. So this is the Blackstone rate slumps looking nasty, and they actually had to stop redemptions. So if you were invested in this, it reached a trigger point. Redemptions of people cashing out of their fund reached a trigger point where they froze it and you couldn't get your currency out. Now, let's remember what was happening back in 2008. Countrywide Financial, which was the one that had made the most egregious loans of, they called them no income, no way. I call it no pulse loans. It wasn't that they couldn't fog a mirror. They had no pulse. I mean, you could actually get a loan for your dog back then and buy a house. And so Countrywide was the most egregious, and that was part of the triggers. The mortgage-backed securities, all the collateralized debt obligations being so risky, and then being rated by the major rating agencies artificially. I mean, they just flat out lied. And they made up these ratings that were AAA ratings and such for mortgage-backed securities. And this all started to unwind, along with Northern Rock bank runs happening in Great Britain. So that was all happening at once. Here's another picture of Northern Rock. But it's one thing starts this unraveling of the financial system. So it's just one little pinprick. Could it be this BlackRock REIT not freezing their redemptions? I don't know. I doubt it. But there's going to be something out there. And, if we continue tightening and the Fed hikes rates again, I'm expecting that there will be some sort of thing that causes the average person to try and search for a safe haven. And when you search for a safe haven, it's gold and silver. And what I did just recently is I bought some more silver. I bought InstaVault, because I used to buy Silver Eagles. I used to buy these mint cases. But the premium that is being charged on Silver Eagles now is outrageous, and it's not the retail dealers getting all of this premium. The mint has a huge seniorage, it's called. So I don't buy the Silver Eagles anymore while the premiums are high. If they ever come down, I might start buying them once again, but right now I'm getting the most ounces for my currency. So in closing, I just want to hit a little meme here. You know, back in '89, the Eastern Bloc countries were putting socialism into the dustbin of their history. And they don't really want to revisit that era. But now, Western teenagers are doing a dumpster drive trying to grab all this socialism trash and revive it. And I mean, it is just so incredibly misguided. And it's for a lot of people, it's from years of a very socialist education in college. So I want to thank you for watching. Do whatever you want with this information. We'll see you next time. Thanks. Bye. At GoldSilver.com, we have a price match guarantee, free shipping, and global storage options. Learn more about how to invest in precious metals at GoldSilver.com.